Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah, and the Talking Point today are the views of Ganeshram Jayaraman. We love having these conversations with him. These are deep, and they, of course, have investing and equity implications. But let's start off with a particular line that caught my eye from not the most recent report, but one of the recent reports, wherein in the strategy note, he's saying that India's shock absorbers are beginning to wear off. Be aware of that fact. You may not necessarily need to beware that. Ganesham, good having you. Thanks for joining in. Why do you say this? And okay, let's start with this. Why do you say this?
Thanks, Neeraj. Good speaking to you as always. So yeah, I think over the last pretty much from pre-COVID or just about COVID time, right? We've been having the view that we can absorb all the shocks that world has thrown at us, be it the COVID-led shocks or be it all the interest rates hikes and inflation risks, how the war presented itself as challenges. Our view right through this period, almost 2.5 years, has been that we are not too worried about the external shocks. We can absorb it, and I think it stems from primarily one key point, which is foreign exchange reserves went up about $200 billion, 50% during this period. Okay, it started just before COVID, and it lasted till about maybe February of this year. And it came in through multiple forms. It came in through India's IT sector exports doing well. It came in because the whole China plus one angle led to exports in general doing well. It came because initial first 18 months or so, the commodity prices were benign. Non-resident Indians remitted more money back home. Foreign direct investment was doing well. You had a whole host of companies, all the unicorns and all the even some of the largest companies in India deleveraging by raising either debt abroad or equity abroad, and all this led to money coming into India. That led to about 15 lakh crores of surplus liquidity in the banking system. That gave muscle to the Reserve Bank to protect the rupee. Till maybe a couple of months back, it gave them the muscle. So India was one of the best performing currencies. Due to this surplus liquidity with banks, in spite of all the forex outflow due to in the last 6 months, due to FII selling, due to higher oil, it was the liquidity in the banking system is unperturbed. RBI has sold dollars, meaning sucked up rupee liquidity. Still no problem. Okay, we have managed it well. No scramble for deposits with banks. Deposit growth is well below credit growth, but no scrambling,
Right.
no panic in money markets, and on all of this helps in interest rate being very not disruptive. Okay, that has led to credit growth being very good because banks are sitting on excess liquidity. So we are at a 10-year plus credit growth, okay, or peak in credit growth, which has kept the engines of the economy going. And due to this, tax collections have been very good. The GST collections are close to all-time high. You're seeing all the the ability for government to absorb the pain due to the war in terms of fertilizer subsidy being almost 2 lakh crores more than budgeted. Okay, food subsidy being more than a lakh crore more than budgeted. They took oil related tax cuts, but no impact on government spending capability. That has kept the demand engines going. Due
Sure.
to this, inflation has been reined in. Government has not passed on the full burden of the fertilizer subsidies, and what it could have otherwise become much more onerous on, and that would have meant some other consumption suffers. That would have meant Reserve Bank get more hawkish. None of this has happened, right? All of this was due to our ability to absorb the shocks, which is what I call as the shock absorbers were there with us. That manifested in how we were recommending clients through this year. Okay, that we said we are not too worried with how the world is looking. We are our ability, our controllables are doing well. Okay, things in our control we have done well, so we are not too perturbed by things outside control. That was our stance through this year. As we speak now, and I think this tone change is visible. Okay, in our assessment, for if the next shock presents itself, it may come because China is opening up. It may come, and due to which commodity prices go up. It may come because The Western world is slowing down and IT can struggle. We are seeing all these signs there. It could come because of job cuts in the Western world, due to which remittances could slow down. It could come in whichever way. I mean, I'm not trying to predict every shock the world can throw at us, but what I try to imagine is, can we absorb the shock? Okay, and in our view, our ability to absorb the next shock is a lot lesser because of three variables. One, the rupee liquidity is at marginal surplus levels. That's one. Second, the forex reserves have fallen. One, due to balance of payments fall of 50 billion. Then there is a mark-to-market issue, and then RBI has also had to sell dollars. All of this has led to a 130 billion fall in forex reserves, and our import cover has come below about 8.5 months or so. And I believe that below 8 months, it will not look healthy. Okay, and in other words, and in RBI's ability to support the rupee on the macro will be put to test. Okay, and that will mean RBI or the government will take some policy stance to either reduce our imports, reduce capital outflows, or try to encourage inflows. We think we have come to a situation where there could be maybe interest rates might have to take some more pressure, some more pain will come on the currency as a result on inflation. So my point is, the comfortable macro that we wear, or what I call as margin of safety on the macro,
It's wearing off a bit.
is wearing off. Okay,
Sure.
now that in standalone is not as important, but in the context of where the market as valuations set in the context of where the earnings expectations have been penciled in, that's where the nervousness comes. Now, that doesn't mean I react right away. Okay, that doesn't mean we start telling investors to take money off the table, or get defensive. No, we will watch. We will watch how the variables improve or deteriorate. We believe learnings have told us that give it 3-4 months. Just watch data. Let's see if the policymakers are taking proactive decisions to rebuild the forex reserves, rebuild the war chest. Because in an uncertain world, we need to have shock absorbers. I'm not saying I can predict every shock, but but ability to withstand it is the key. And I think there are some key monitorables for us, and hence the word saying be aware but not beware.
Okay, so you're watching the forex reserves very, very closely as one of the key factors, even from an equity investor's perspective, Ganeshram.
Absolutely, I think it has ramifications on equity big time, because if the next $25 billion fall in forex reserves will mean the rupee liquidity turns negative. That means interest rates can go up. That means our view on how real estate sector can revive, and that our view on how, as a result, we've had a very strong view on the cyclicals reviving. Our model portfolio has recommended industrials significant bias towards it. There is invariably either a government spend angle to it. Interest rates have an implication on it. The macro has a very impact on it. Okay, now in that context, all markets are interdependent. The elements on how the forex reserves have an implication on earnings and growth and volume valuations, they're all interlinked. We don't want to be reacting later.
Ganeshram, the other aspect though is that while India is doing a lot on substituting imports and making those bases large enough for exports as well, the latest batch of EXIM data is not very promising. So if the deficit levels continue, very difficult to see forex reserves getting built up. And therefore, my question to you would be, would you be a lot more cautious? And would the risks be on the downside as opposed to the risk being on the upside?
If current account deficit is one way, okay, I mean, trade deficit is one, current account deficit is another, because India has a large IT and Indian NRIs, non-resident Indians remitting money back home. So current account deficit matters more than trade deficit in an Indian context. but also what matters is how good or bad the world is, and how can India attract capital flows. Okay, so that will also have a bearing on the forex reserve. So not just current account, but the capital account and the other variables. So all these are important to watch. But another important thing is, can earnings picture in India in isolation, can it see upgrades, and can we be continue to be the supposed oasis of growth in the world, right? It's narrative. It's a nice narrative to have, and I see there is a lot of positive momentum built around it. But I don't want to fall prey to short-term narratives. These can change. But the broader point is, I think we need to be watchful. We need to see if over the next 3 months we improve our macro variables. Given, see, all of this is important because our recommended model portfolio stance has been very cyclical sectors oriented, and it's done very well. Like our two largest overweights have been banks and industrials. Okay, and these sectors have done extremely well, and other sector was autos and categories of discretionary consumption, which have also done well. So almost 85% of our recommended weights on our model portfolio where are banks, industrials, and autos, and categories of discretionary consumption. So in that context, we need to be a little more wary, in the sense we need to ask ourselves, are we recommending the right sectors in the kind of macro that we could have next year? Should we buy domestic defensives sectors like staples, utilities, maybe telecom, pockets of stable growth, not leveraged growth, not cyclical dependent sectors. They are more smaller ticket size, or a lot more resilient demand characters. Should we bias towards them, or should we go towards global defensives like pharma? Healthcare is another sector of domestic defensive. So the defensive bias is something that we need to relook at. The other sector is global cyclicals, where sectors like metals, or it could be IT, it could be chemicals. So again, with the way our view is, we have been varied towards many of them, more top-down, bottom-up sector views. We've been cautious on them as well. So these four quadrants, right? Domestic cyclicals, domestic defensives, global cyclicals, global defensives. We have been lopsided towards domestic cyclicals for the last 2.5 years. And whether we need to relook at it is a big call. Turning the ship is not going to be easy. It's not going to be quick. So we will need to calibrate, be slow, watch, and be certain of what we are saying. We are still in that in-between phase.
That's what I was going to ask. You haven't made those changes as yet. You're watching this, and you might want to make that swaps selectively, maybe.
If not even selectively yet, not made any change yet. We are sticking to our stance. In other words, we are just saying that watch it, be wary, but not in that beware camp yet. So we are be aware camp, as I've said. And just watchful. And I think market also is in the same frame of mind. It is, we don't want to be abrupt too soon and react that and realize later that we were a little too soon, because things can change. We need to give it time and then see if nothing is changing, and then maybe take a stand.
Got it. Ganeshram, I want to talk about food in a bit, but since we're on the topic of markets, let me finish that, stitch that point completely. So I was reading an article that Avendus wrote for us on our website, in where they have married quantitatives and fundamentals and shown that history shows that in cases or periods wherein interest rates are higher, above average, and likely to inch higher as might be the case, sectors like real estate, etc., obvious, which don't do well, but even telecom doesn't do well. I heard you somewhere in your answers talk about how you might be tempted if indeed the thing that you fear might happen, then telecom might be a case. Why so? Because one, it is not under leveraged. Two, history has shown that telecom typically doesn't do all that well at times when interest rates are higher. So why telecom?
In the past, you had a lot of leverage in telecom companies. Today, there isn't much leverage in them. So I don't want to extrapolate past trends on telecom anymore. But uh, just keep in mind that a lot of expectations on telecom stocks are baking in tariff hikes. Okay, and tariff hikes mean inflation. Okay, because let's face it, telecom companies raise tariffs say 20%. I'm just hypothetically telling you.
Yeah.
Has implications on inflation. Okay, has implications on how the overall CPI will evolve. So we think there could be restrictions. I might in some form challenges to take a strong tariff hike if inflation is indeed going to sustain and if it gets worse, telecom sector's ability to take tariff hike could be also put to test.
Got it. And the other point, I saw in your port, by the way, the October note that there was a real estate stock which you've taken out of your portfolio, I reckon. I wanted to understand, all through the last 2 years, there are people who've looked at cycles long enough saying that typically when a real estate cycle turns, it doesn't turn for 1 or 2 years. There is a slightly more sustainable turn to it. Till now, the numbers are not looking bad. Sure, month on month in October, they have looked slightly off, but it was still a very large absolute number. So we are selling, India is selling copious amounts of real estate. But at the same time, rising rates typically don't augur well. So what's your sense of how would the market look at the fundamental development, which is the high quantum of sales happening, vis-a-vis the technical overhang of higher interest rates, presuming that rates stay where they are or move up slightly from where they are right now?
If rates stay where they are, they're not going to pose a problem for consumers. If rates go up another 100 basis points on home loans, the problem has become that a lot of or a very high proportion of home loans, unlike in the past, this time they are repo linked loans. Okay, so repo rate linked loans. Earlier, it used to do it, so it was the repricing of home loans was not as abrupt, as swift as it is right now, because today you're seeing sharp repo rate hikes, but overall interest rates are not going. The blended cost of funds for banks are not going up as much as the repo linked loans are going up. So the home loans are repricing very fast, much faster than other categories of loans. That is having one point. But the bigger point is we remain positive on property. Okay, I think as we stand today, we want to stay believing that the property cycle is here for a long cycle of recovery. We are maybe 2 years into the recovery. Real estate cycles tend to last 5 to 7 years, and because the construction cycle itself is 3 years, and the last 2 years have been more of unsold inventory getting cleared. Okay, it's not new inventory coming in. We are yet to see. We have seen improvements on sales, which are still unsold inventory. We need to see momentum pick up on new launches. Okay, we are confident it will come, but it's not like the new launches are flooding in. So it's not yet a full blown cycle on the property front yet, and but we think very high chances that as long as interest rates stay where they are and not go up another 100 basis points, we don't think the likelihood of the real estate cycle getting derailed appears low. And if rates go up 100 basis points, I think property, it could be at risk. That is where we are looking to. So again, one more sector which are at crossroads.
Yeah, well, too many of them, unfortunately, these days. Ganeshram, one more line, and then I'll go to the final question on the macro again, which are cool. But you mentioned in October note that you are diving deeper into operating leverage and attempting to look at companies that have already made investments over the past few years. Now, that's a great strategy. In this October earnings season or July to September earnings season, there are a bunch of names who have said that, hey, our capex is already over. Now we'll start to reap benefits. At the same time, the big theme in the market in the last 6 months when I talk to people, or at least the preference that people have on the buy side, is looking for companies which will benefit from the upcoming capex cycle.
Yeah.
Now, tell me, you, and of course, your portfolios can have both. So I'm trying to understand, where are you bent more towards? Do you want to take advantage of companies which have already done capex? And that's a very different thing from companies which benefit out of capex. But I'm just trying to understand,
Absolutely.
where would you put a bigger bang for the buck?
Yeah, it can sound a little dichotomous that you are on one hand betting on companies who have done capex. There is so much of operating leverage left. On the other hand, you are betting on capex itself, which means it. Yeah, but the fact is that's two different sectors. Okay,
Precisely.
the sectors which are where we see capex coming are sectors like steel or other metals, some pockets of cement, some especially geographically, are a lot of ESG related spend on capex. You're going to see a fair bit of capex coming in, sectors bit in refining or oil and oil more than gas specifically. You're going to see it in textiles. You're going to see in a lot of PSU companies in various sectors within the sectors itself. So the drivers of capex are actually a lot different. You're also going to see a lot more brownfield capex this time, which means it will take a lot less time. So the earlier greenfield used to take 5 years, brownfield takes 18 to 24 months, which means the cycle can be a lot faster. The earnings drivers can be faster. You're seeing a newer category of telecom spend, telecom capex. Earlier you saw it in the form of telecom infrastructure being put. Now it's going to be more data centers. Okay, so telecom infrastructure means a lot more imported equipments. Data centers means local equipments. Okay, so the character of capex is changing. So the beneficiaries, another important variable is the whole the incentives for manufacturing. The huge number of multinational corporates are putting up in line with the PLI led scheme. These are not capex intensive, but the second order, third order is very interesting. So SME capex can pick up. So and we are also seeing import substitution being taken by say consumer durable companies, for example, right? So a lot of small and medium enterprises are seeing demand reviving for them because India is importing lesser, say for example, cell phones. Okay, so a lot less, the employment it is creating, or the rub-off of employment, in the form of say dormitories and restaurants and buses being bought for transporting the people, and because you are talking of tens of thousands of uh, 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 you know labor being hired for these need. There's a fair bit of dexterity of the hands needed. So the character of hiring is very different. Okay, it's more blue collar. It's a different approach. So that means the character of capex driving it is also different. So all these need to be reckoned. So when we look at capex or the beneficiaries of capex, for sure it's a big call for us, and we believe there are pockets of capex very likely to play out. We also believe that the character of inflation the world and India is seeing is supply side, not demand led alone. In some pockets it is demand led, but it is largely supply led, and the solution for that capex is getting more supply. It's not, which means you have to see character of capex globally also change, and that means you need to prepare yourself for beneficiaries of capex and financiers of capex also. Okay, so that is also an important variable, the corporate banks I meant. So we need to position ourselves. Having said all of this on the capex side, the operating leverage is also, that's another sector. Sectors like autos or various categories of consumption. Okay, and you're seeing even in a cement there are companies who have done the capex. Okay, yes. And for whom there is so much of operating leverage. And if there is one reason on the bottom up which still excites me, it is operating leverage. Okay, the companies have seen they've put the capex, they have protected per unit gross profit, not gross profit margins. Okay, not absolute gross profit. I'm looking at gross profit per car sold or per motorbike sold. And then they've upfronted OPEX. Okay, so what you will see is the combined effect of all these three: CapEx done, gross profit per unit protected, OPEX has been upfronted, means there is a lot more asset turns upside. There's a lot more, the operating leverage potential. So valuations, what appears 35p, okay, or 25 times EV EBITDA, can be misleading, and we think operating leverage cannot be easily fully predicted well enough, because companies are asset turns and margins are not at nowhere close to cyclical peaks. So which means that also goes into my first point, that the be aware not beware point is also because there is still margin of safety in earnings. Okay,
Sure.
not near term earnings, but if I take a medium term 18-month or a medium term view, I'm not saying 5-year views, okay, even on an 18-month horizon, this operating leverage can surprise, and especially if commodity prices come off, the way managements have in the past demonstrated pricing power is, when raw material prices come down, they do
Pass
not
on
pass
that.
it on fully. So you will see gross profit per unit improve, margins improve, operating leverage pick up, and that is when the full benefit of operating leverage will show up. So we can't ignore operating leverage upside in the way we are recommending the sectors and the stocks as well. So as I said, it's a crossroads. You will on one hand keep an eye on the macro, because that can hurt volume growth. Okay, whereas you need to look at value growth, you need to look at operating leverage, you need to look at raw material prices. They too can be conflicting, and then take a stance on whether how earnings can shape up next year into fiscal 24 estimates, whether we can see upsides, upgrades, or downgrades. The quarter which went by has seen very limited earnings upgrades, except in banks. Very very few pockets have given us earnings upgrades, and that's not helped the case. But I don't want to extrapolate, because the September quarter was, at the end of the day, an impact of the previous quarter's spike in raw material prices there
Yeah,
still.
sure.
So somewhere there is still hesitancy to take upgrades, and volume growth is where operating leverage will show up. Volume growth is critical, and the next 12-18 months, if we do not see volume pick up in sectors like, say, it could be on cement, or it could be on property, it could be on autos, discretionary consumption, various baskets. We could see a situation where this operating leverage doesn't play out, and that means a fair bit of valuation isn't fully justified. Okay, that
Interesting.
could see, especially in a world where you're seeing rates go up. And one more element in this whole thing is, we have seen a pretty poor quarter on cash flows. Okay, balance sheets have seen much higher working capital this quarter end, this September quarter end. So yeah, festive season was early this time, so you could have seen upfronting of inventorization. So that may be one reason. So we again don't want to react to scenarios which have played out of late, but it's time to be watchful. Is my concluding point is, being watchful will actually pay off than being complacent.
Okay. Yeah, unfortunately, out of time now, viewers, but would have loved to talk about the food aspect, because I think in all the slides he speaks about how extension of free food scheme can lead to a pullback in government capex, or could food inflation play a spoil sport due to excess rain or drought. I think we'll have to save it for another day. But this was lovely, Ganeshram. Thank you so much for detailing out a lot of the stuff that you've written in the note and your thoughts. Much appreciated.
Thanks. Always good speaking to you.
Yeah, likewise, and viewers, thanks for tuning into this edition of The Talking Point.